Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. You can pick it up online at amazon.com or amazon.ca or check it out in your local library. You can go to your bookstore as well at Indigo, Kohl's, or Chapters. So today I'm going to be talking about small companies, big dreams. When I was younger, around 18 to the age of 25, I started investing when I was 18. I would usually pass up on those smaller companies. So any company that was under 100 million in market cap, I would usually pass up. But they still ended up, popping up on my stock screener. And the reason why I passed up on these small companies, microcaps, is that I was fearful of, these undiscovered small companies, because of, their small size. There wasn't much ownership, by big banks, big institutions. These companies have very slim trading volume, and there was little analyst coverage. And it was really the fear of the unknown, betting on a tiny company that might fail. I didn't want to lose my money on a dumb trade, and I didn't want to look stupid. However, as years went by, I passed on these small companies that came up in my screener. It led to a lot of regret because I started seeing some of these small companies I passed up, go from 100 million to $1 billion in market cap, right? 10 times. I saw some go from that 100 million to $1 billion. I saw some go from 100 million to 500 million, 5 times, 3 times. And, these stocks were achieving multi-bagger status. And these are really the ones that got away from me. And it was a painful phase. I would repeatedly ask myself, why didn't I invest in that stock? Popped up my screener. I conducted extensive independent research. I should have pulled the trigger. But I'm also a realist, and I understand that while all great companies start small, not all small companies become great, or in other words, big, right? So very few companies in reality get there. The majority of companies, to be honest, listed on the TSX Venture Exchange, which have all the small companies here in Canada, are just downright uninvestable. Some of these companies should have never gone public in the first place. The shoddy business models, questionable shell holding companies, people call these zombie companies. And there's quite a few bad actors promoting, pumping, and then dumping garbage. It is actually, quite depressing at times, sifting through and pulling up the charts of some of these TSX venture stocks, right? And there's countless flameouts. So you'll see, venture stock, it'll IPO, let's say in 2015. It'll rise up, let's say 100%, it'll double, but then completely flame out and not recover since. So therefore, I believe that achieving a semblance of success in microcap investing comes down to first eliminating the bad batch. So 80% of stocks, on the venture exchange, are just bad batch. I would just eliminate them straight away from the microcap universe, so that one can focus on the good batch, the 20% that contain meaningful companies with real future prospects. And these are companies that are managed by responsible and enterprising owners and operators. Because, when companies are at an early stage in their business life cycle, you really are betting more on the jockey than the horse, hoping that the jockey, i.e. the CEO, is not only honest and able, but executes on his vision and delivers shareholder value. Here's the thing though, even if you do pull the trigger and invest in a promising small company, will you have the conviction and wherewithal to hold that stock from 100 million to $1 billion in market cap, right? Will you be able to see it go up 10 times? The reason why I ask that question is because, successful small stocks don't just shoot straight up. They're highly volatile, which means there's lots of ups and downs in their stock price over time. And the question is, can you stomach watching a small stock drop 20% in a day, then rise 10% the next day, and then lose 75% of its value within the following year? Well, here's a case study. That was what happened with Amazon. Right? It was a wild ride for Amazon. Right? Sure, from 1997 to 2017, 20 years, Amazon stock went up 38,000%. But its trajectory certainly was not linear. Amazon had its IPO in 1997 and started trading at $18 per share. Now, MarketWatch, if you look this up on Google, they succinctly outlined Amazon's trials and tribulations over that period. Amazon fell 95% from December 1999 to October 2001. This was the tech bubble and bust. And then fell again 64%. That was a major drawdown in 2008, financial crisis. In fact, Amazon suffered a double-digit drawdown every year since going public, and a 20% drop in 16 out of the 20 years, right, from 1977 to 2017. Here's the thing then. Who do you think has owned Amazon since its 1997 IPO from the very start? Very few investors bought Amazon stock at 18 and held all the way up until $1,800 per share, which it's trading at now at the week of July 16th in 2008. Now, the ones who did hold Amazon since 1997 were either crazy, genius, or simply forgot to check on their stock portfolio for 20 years, though they are probably all now relaxing on a beach somewhere. In hindsight, it is interesting to think that most people thought investing in Amazon as recently as even 5 to 10 years ago was crazy. The majority in 2013 were still doubters, focusing on Amazon's lack of net income, obscene price-to-earnings multiple, and calling the company grossly overvalued. Many so-called analysts were claiming that Amazon was overvalued all the way up until recently, when Jeff Bezos finally cracked the list of top 10 richest people in the world. However, it is only now that Bezos is the richest man in the world that most people have realized that they missed out on one of the greatest wealth-creating opportunities the world has ever seen. I too am guilty. I should have listened to my non-investor university roommate back in the day, I'll call him Bob, who in 2006 said, "Hey Robin, you should really invest in Amazon." My response at the time, "It's overvalued." So here's a similar but Canadian story. In 2007, I was age 20 at the time, I invested in a small company on the TSX. It was called SXC Health Solutions. It was a healthcare pharmacy technology company. After conducting my own extensive research and due diligence. After investing in SXC Health Solutions, the stock whipsawed so much that I became fearful and sold 100% of my position that same year. I decided to banish SXC Health Solutions from my memory, never to look at or invest in the company again. Years later, in 2012, it would change its name to Catamaran Corp. And then in 2015, I read in the Wall Street Journal that United Health Group had announced it was going to acquire Catamaran Corp for $12.8 billion. I subsequently took a long walk around the block to cool off. Had I not sold my position in XXC Health Solutions, which became Catamaran, I would have generated multi-bagger returns in my portfolio. Now, this was not the only case that I invested in a small stock and later sold out because of fear. In addition, I cannot count how many errors of omission, which is not buying the stock after extensive research, I have committed through my DIY do-it-yourself investment career. I have many regrets, which is why since age 25, what I do is I plant seeds and water the trees. Or in other words, invest small amounts in microcaps, so those stocks trading at less than 100 million in market capitalization, the smallest stocks in the stock exchange. I'll invest in those, and then over time invest more into the ones that win, the winners. I'll average up essentially, versus most people who will dollar cost average. They'll add more money to stocks that are going down, which I do not do. Here's an example of something, at the age of 27, I invested in. It was Tweed. So in my book, Market Masters, I actually wrote in the back pages in the conclusion that in the year 2015, before marijuana became the must-own sector, I bought Tweed at around $1 per share. It later became Canopy Growth, a leader in the marijuana industry, that now trades around $40 per share. So, that's a 40 times return on investment. But owning Tweed was not easy. though I learned from my past mistakes. Tweed was a dead stock for about 1 year and then soared in the marijuana legalization tailwind after the Liberals won the federal election. The stock then soared again following the announcement that Constellation Brands had invested a 10% stake in the company. However, through that time, Tweed/Canopy Growth, right, same company, incurred wild swings up and down. The stock did not shoot straight up and had many doubters. Investing in Canopy Growth early on and achieving a multi-bagger has certainly driven my pursuit of discovering more small companies with lots of potential. I might never top that 40 bagger in Tweed/Canopy Growth, but I will certainly not fail to try. It's all about discovering new opportunities. So here is my discovery process for small companies. Once per quarter, so every 3 months, what I'll do is I'll scour all the companies on SEDAR, SEDAR. That is the official site in Canada that provides access to most public securities documents and information filed by issuers within the 13 provincial and territorial security regulatory authorities here in Canada. Again, so I'll go on SEDAR. I'll look for new issuers as well as new quarterly reports from the existing companies there. I will skip over every single resource, which is oil and gas, mining, etc. company. I only invest in technology, consumer products/services, and diversified industries. These three industry groups are less cyclical and more predictable than other industries. I like to use SEDAR as stock filters and screeners might eliminate worthwhile small companies from my view. Also, years of poring over thousands of financial statements on SEDAR builds an intuition-like skill in the future, whereby promising companies start to just jump off the screen. In quarterly reports, I look for high revenue growth, positive cash flow from operations, low levels of debt, and positive net income. However, I will still shortlist a small company that is not generating income, but does have a path to profitability in the future. My biggest focus for small companies, again, small companies being those which have a market capitalization of under 100 million, is high sustainable revenue growth. So I look at, if I look at their first quarter of this year, I compare their growth from last year to this year. So year-over-year growth in the quarter. I look at their annual year-over-year growth. So for example, 2016 to 2017. And then their 3 to 5 year compound annual growth rate, CAGR. This revenue is fueled by new contracts, the company's winning, accretive acquisitions they might be making, penetration into new markets, and or expanding unit volume. I will also use the official TMX stock listing inventories as reference to help guide me through my discovery process. So if you go to Google, you type in TMX money, you'll see there, if you click under research, you can look at different industries, and there's an inventory, an Excel spreadsheet for each of the major industries on the Toronto Stock Exchanges. And the ones I click on are technology and diversified industries. Now, diversified industries on the TMX website also includes all the consumer products and services companies. So I download each of these inventory Excel files, and this helps guide me. There's about 750 stocks in this initial universe within these focused industries I look at. But stock screeners do still play a role in my discovery process, especially to focus on metrics like market cap, revenue growth, and cash flow yields, as we talked about before. It's really an easy way to check companies through screeners. I use TMX Stock Screener. Again, TMX Money, if you just type that into Google. I believe it's the most accurate for Canadian stock data. But in addition, I've used screeners on StockWatch and Yahoo Finance. However, I can't stress enough that DIY investors should scour all companies on SEDAR, as screeners might miss some stocks. Finally, I will check the predefined scans on stockcharts.com every day, Monday through Friday, after 4 p.m. market close. What interests me are the stocks that are making new 52-week highs and or stocks trading on higher than average volume. This gets me thinking that something interesting might be going on, and I search further into the possible catalysts as to why stocks are going up or why there's more volume coming into them via press releases, etc. So at this point, I've started to build a watch list of small Canadian companies, and will exit the discovery phase and then enter the next phase, which is research and due diligence. So in this phase, I'll dig separately into each one of these companies as much as possible, identifying factors that can lead to breakouts and sustainable growth. Multiple sources of information aid me in this research process, including company websites. When you go to a company website, for example, if you're researching Organic Garage, which is a small grocer growing and expanding here in Toronto and across Canada, you can go to Organic Garage and you click on their investor relations section. And every company website has an investor relations section. I'll go to stockhouse.com. I think it's a pretty great forum where people are talking about all sorts of companies, but mainly small and microcap companies. But you've got to be careful. There's some bad actors in there that are promoting and pumping stocks. I'll also go on Twitter. Twitter is just a great treasure trove of information. There's some pretty amazing microcap investors on Twitter who share their research on companies. And I'll conduct searches online, right, through Google. Type in the company. You can find press releases on there, and sometimes you'll find blog posts that other investors are posting on their own blogs. I also like to see whether any respectable funds or private investors hold these stocks in their portfolios. So specifically, I'll check on Jerry Wimmer. Jerry Wimmer's investor file. He's got a website. Moyers, that's M-A-W-E-R, has a new Canada fund. They invest in some small and mid-cap companies. And then Pender Small Cap Opportunities Fund, among others. I'll validate some of my stocks that I'm starting to shortlist down further with what they own. Further, management access would be ideal. Unfortunately, right, most do-it-yourself investors, you can't just pick up the phone and call the CEO. Therefore, in the past, what I've done, I've attended annual shareholder meetings and have dialed into quarterly calls. I'll also try to find any CEO or management interviews on YouTube. So again, I'll go back to the example of Organic Garage. If you go to YouTube, type in Organic Garage, the CEO's name is Matt Lurie. You can find information on him. He gives interviews. And based on that, you can decide whether you want to shortlist or move on with that company. Finally, if there's a product or a service or a storefront you can go to visit to try out the product yourself or service, you should definitely do that. Throughout my research process, there are certain qualities in these small company stocks that help me determine whether I move them from my watch list to my potential buy list. So I'm going to share with you now my qualification process in the form of questions that I ask myself to help me qualify each and every one of these companies. So here are some of these qualification questions. First is, what are the products and services? Does this company offer something new and unique to the market? Is there new technology? Would anybody be unhappy if this company went out of business tomorrow? Would I buy their products or services myself? Is there lasting utility or appeal? Who is running the company? Is it an owner-operator, or is it a CEO that's been installed to run the company? Is there a bold vision for the company? What is the CEO's track record in leading other public companies and executing on a vision? What is management's stake in the company? That is, what is the insider ownership percentage of shares outstanding? Are they buying stock in the company? Is management overpaying themselves as a percentage of revenue? How big is the addressable market for this company? How can the company scale to expand and fulfill demand for its products and services domestically? So, in Canada and the States, and then globally as well. Can it achieve profitable growth? How easy will it be to acquire and onboard new customers? What is the business model? Are revenues repeatable and recurring? For example, software as a service subscriptions? Or are revenues inconsistent and cyclical? Example, a manufacturer that produces gas tanks for the oil and gas industry. Are profit margins good? How will they improve? Is the company structure, workforce, and sales/marketing group in place for the company to succeed? Another question is the company vulnerable to business cycles? What would happen in a recession? Does the company have ample net cash on hand so that they are not vulnerable to economic down cycles? Can growth be funded through its own operations? What is the capital structure? Another question is, does management have a focused acquisition plan? Have they successfully integrated complementary companies? Is the industry in which they operate fragmented? And so is there an opportunity for this company to consolidate smaller companies? Are there positive tailwinds? Are tailwinds anticipated in the future? For example, elder care, and with a large cohort of the baby boomer generation who are getting older, they're going to need places to live, and there's also some technology that caters to this space as well. What is the regulatory environment? Can regulations dampen the company's growth? Conversely, could regulation bolster company growth? For example, in the cannabis industry, licensing all these new corporations to manufacture and to sell marijuana, like almost literally a license to print money. Does the company have sufficient cost controls in place? Will the company innovate? What is the culture? What is the current research and development spend? Note, research and development is more important for technology companies. Does the company plan to expand its product and or service selection? You really don't want a company to be a one-trick pony, for example. Can the company achieve a competitive advantage, or what Buffett says, a moat, and fend off any competition? If there is competition, though, is there room for multiple players? Does the company own any intellectual property? What are the switching costs? Is moving to a competitor easy? Who is promoting and supporting the company? Is it underfollowed by analysts and underowned by institutions? What is the daily/weekly share volume? Can a Chinese or other low-cost competitor simply produce these goods and or services cheaper? Or does this company have a following, as in like a good brand, or a better way of making the product and delivering the service? Can a company like Amazon catch on to this opportunity and easily steal market share? Is the stock price validating the company's positive developments and quarterly releases? For example, a 25% Q1 year-over-year revenue gain, is that followed by a positive price momentum in the stock? Do you see the stock going up based on good news? Does the company have any prominent short sellers? For example, Mark Ojeda, Andrew Left, Carson Block. If so, do you believe the short thesis? Have you considered worst case scenarios for the company? Finally, can this company grow 3 times bigger? For example, go from 100 million in market cap to 300 million in market cap in 3 to 5 years. Will the high sales growth continue for years to come? Can the company attract a shareholder base where large investors and institutions can take the company to the next level? Ultimately, I invest in small companies that pass most of my qualification questions that I just talked about. Because I allocate small chunks of capital to these microcap stocks at the onset, I have the wherewithal to hold through volatile swings in the market. After planting the seeds, I will water the stocks that grow, average up, and hold the stocks that I still have conviction in. I would like to share with you my current universe of small companies. And these are, as a title in the YouTube video, describe my current universe of small companies I track, Canadian companies that are traded on the TSX. There's 60 of them. The average size of each is 63 million in market capitalizations. These are microcaps. I have applied both my discovery and qualification processes to arrive at these 60 small companies, but through your own qualification process, you might arrive at a different set of companies. Again, I'll continue to track them in my newsletter. I do encourage you, please subscribe to my newsletter. Go to robinspeziale.com or search my name, Robin Speziale, in Google. Click on my website, click on subscribe, and I'll send you email updates. And so if you do go to my website, you'll see the entire list. Go to my blog of all of these 60 companies that I arrived at through my discovery and qualification process. I won't name all 60 companies here. You can check those out on my website. But what I will name here is that a subset, about a third of those 60 companies, what I did, I applied certain metrics, certain hurdles, and only a third of these 60 companies actually made it over these hurdles. And the hurdles are their latest quarter year-over-year revenue growth. It has to be over 0%. Their latest annual year-over-year revenue growth has to be over 0%. And their last 5-year revenue compound annual growth rate has to be over 0%. So those are the revenue hurdles all these companies made. And then finally, they all need to be cash flow positive. So the fourth hurdle is greater than 0% cash flow yield. And so this subset, there's 21 companies out of the 60 they returned an average of 20%. So on an average, in this little basket, they were up 20% year to date. So from January 1st, 2018 through July 10th, 2018. That's not to say that they'll continue to deliver high returns, but this is, again, this is in the past. And some of these companies, actually I'll name all of them, in the subset are XPEL Technologies, Organic Garage, Titanium Transportation, Evergreen Gaming, Avante Logics, Symbility Solutions, PartnerJet, Hamilton Thorne, Ready Shred Capital, Bevo Agro, Diamond Estates Wine and Spirits, Caldwell Partners International, Intrinsic Technologies, AirIQ, Namesys, 10 Peaks Coffee, WITWI, Cortex Business Solutions, Nanotech Security, Sonora Foods, and Quarter Hill. Again, you can see this, list of, I call them highest proven growth, 21 companies. Or, you can also see my big list of 60 small companies if you go to my website, robinspeziale.com. Now, in conclusion, I really do enjoy, searching for, finding these promising small companies. To me, it's like a quest, right? Some people collect stamps or coins, or other things, Coca-Cola products, whatever. I really enjoy collecting stocks and just finding them. The enterprising do-it-yourself investor, including you really have an edge. And the edge is the ability to not only find companies when they're small and undiscovered, but also to invest in them as institutions have restrictions on holding low market caps in their portfolio. In addition, there's usually no analyst coverage for these companies trading under $100 million in market cap. Thus, the market cap universe is largely uncharted territory. The delight comes when a small company that you find and invest in grows into a larger one, crossing that, the chasm from microcap into small cap, and then maybe into mid cap and beyond. That is the dream. It doesn't always happen, obviously. While it's rare for a company to grow from 100 million to a billion, 10 times, it's even rarer for a company to grow from 100 million to 10 billion, which would be 100 times, 100 bagger. The process, though, is still fun, in my opinion. In those rare cases, it can be very rewarding for do-it-yourself investors managing a small portfolio, anything under $1 million. Buffett, this isn't very well known, but Buffett once said that the highest rates of return I've ever achieved, he said, were in the 1950s. I killed the Dow, Buffett said. You ought to see the numbers. But I was investing peanuts then. It was a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million, said Buffett. No, I know I could. I guarantee that. End quote. Anyways, guys, hope you enjoyed this video. If you have any questions for me, please contact me. r.speziale@gmail.com. Go on my website, you can find my email there. You can find me on Facebook, you can find me on Twitter, you can send me a private message through Twitter too. But until next time, happy investing. Have a great time, guys. Bye.